Our chief equity strategist and economist, John Blank, wrote recently that the bulk of what happened to large cap U.S. stock indices over the last month was a stock options volatility spike and then a subsequent rapid VIX reduction. John's here now to explain all of that, elaborate just a little bit. John, was this due to the uncertain landscape that's out there in the marketplace, and how has this volatility whipsaw resolved itself?
Yeah, Terry. So on April the 8th, which is back in the days of the Liberation Day tariff announcement, we got to a VIX of 52.3, 52.3. And I'm speaking with you on May the 21st. And we've been walking down all the way to 18.6 on the VIX on May the 21st. So volatility has fallen, but it used to be, Terry, back in early May or early February, I'm sorry, it was down at 15. So we're still, 3 points of volatility above where we were in February, but of course we're way, way down from the April spike at Liberation Day. What I will tell you, though, is, Terry, it looks like we're planing out now. And as you've noticed, the trading action the last couple of days has been negative to flat. And that's consistent with this volatility story that, just wrenching the volatility down was a lot of what happened over the last month.
So, what does this mean for the stock market volatility story going forward?
Well, the question I pose to you is, do we go from 18 to 25, or do we still trickle down to 15, or do we stay at 18 and go sideways? I mean, you've got three scenarios here, and it's an event-driven outcome. So I think, given the uncertainty and the volatility of the emergency orders that are driving the volatility, there's no way to pin which of those scenarios is more likely. I think all three will be likely over the next course of this year.
So, really, then, can't tell how long it might take for the market to gain a solid footing here?
Yeah, I mean, we're talking about a, quote, solid footing at 18, Terry, but again, that's more volatility than we started with back in February.
Yeah. So, how do you view investors' risk appetite currently, especially in light of the U.S. and China trade picture?
Well, it appears from the data that, the retail investors did buy the dip and succeeded this last month. But the institutional investors who were worried about what's going on in the bond market, particularly as we broke 4.5% on the 10-year Treasury yield, which is the benchmark everybody watches, we're at 4.54 this morning. That is very concerning to the institutional crowd, which believes there's a deeper shift away from U.S. treasuries, U.S. dollars, and the U.S. stock market all at once in the face of the concerns over the isolation of the U.S. administration and the way it's taking the U.S. economy in that direction, too.
So, based on the Q1 earnings season, it appears to me, and correct me if I'm wrong, that tech stocks still appear to be strong. What have we learned from the Q1 mega cap tech reports?
Well, we've learned that, the secular theme of AI capital investment was not disrupted by the change in administrations whatsoever. And that, there's still so much opportunity and competition and fear amongst the major tech companies that they're still putting the billions to work and they're still pushing forward on that. So the tech sector has, showed us that there's more to this market than an administrative change at the federal government level, driving performances of shares, and you need to be mindful of that. That news cycles, particularly when they're manipulated as much as ours are, can over focus you on some types of news and not focus on the banal news of something like the ongoing AI transformation.
So, for the last 10 years, four mega cap tech stocks drove the U.S. large cap indexes. Overall, what's the bull bear story on these tech stocks?
Well, Terry, we've got, those are Amazon, Microsoft, Apple, and NVIDIA. And they're all, continuing to have multi-trillion-dollar market caps, and that's 25% of the S&P 500 and a much higher multiple. So the question we have to ask ourselves is that at the 21.4 forward P multiple for the S&P 500, when I looked this morning, a lot of the 20-something PE multiples are those big mega cap names. The average equal weight names are around 17, which is not so bad. So the question is, though, should we really start to think of these big names as being overvalued too, and that has yet to be a sentiment that's widely felt. But I'll put it on the table for people to digest.
That's interesting. Based on the overvalue and after the group's strong Q1 earnings results, do you see another big tech rally around the corner?
Well, that gets to the bond vigilante story, Terry. The problem is once you're at 21 or 25 or 28 PEs, you're pricing in all the good news, and you're not pricing in any of the bad news, and you also are not looking at what our mechanical asset allocation moves, which put money to work out of stocks and into bonds when the bond market rallies up and yields look so attractive, particularly if they get over 5% of the 10-year. So what can happen here, Terry? Earnings estimates can be ground down by the tariff stories, and the new fiscal budget can get the bond vigilantes excited and push the 10-year over 5, and the mechanical asset allocators will just go mechanically adjust the bonds and out of stocks, and we'll be back to an 18 PE just on that motion alone. So that is a very concerning thing for the institutional investor who knows about these asset allocation machines.
So, based on what we've all talked about here, looking ahead, are the tech mega caps a buy?
I'm neutral on them, Terry. I think you got to own tech, and that means you got to own these names. But I certainly would be looking to take some profits on any overweight names that I have.
All right. As for the Q1 earnings season in general, going into it, investors had been hoping strong earnings could revive enthusiasm for stocks, especially on the heels of the worst quarterly performance for the S&P 500 since 2022. Given recent volatility, do you think that's happened?
Yeah, it absolutely has happened, Terry. Today, even this morning, we have Target taking down the Dow and the S&P 500, but the Nasdaq's almost flat, and so people are buying the tech names for the stories we've put out today.
All right, a large cap Dutch grocery chain, a Canadian insurance group, and a Spanish tech services firm all on your stock radar right now, and they include Ahold, hope I pronounced that right, Fairfax Financial, and Amadeus IT Group.
Yeah, Ahold is up. They're based in the Netherlands, Terry. Target price of $48. I've got them at 43. This stock has gone in this year alone from 31 to 43. So this is the story of people shifting into names in Europe and out of names in the overvalued U.S. stock market. And why are they doing that? Yeah, of course, it's got a number 2 rank for buy, but it also has an A for value and an A for growth, Terry. The other names I'm looking at, Fairfax Financial, ticker, you may not know this name because it's Canadian, FRFHF. This is crazy, Terry. It's at $1,635 a share. Back in 2023, you could have bought it for $450, and now the target price is $1,881. So a crazy story here. Again, a number 1 ranked buy. But the PE ratio, Terry, even at that level, is only a 9.2 because it's Canadian. And so the value score is A. And again, people are looking at this name and going, geez, why don't I buy a big financial company in Canada with a $37 billion market cap and ride it higher with a 9 PE ratio. So that's the story here. Amadeus is a different story altogether, Terry. It's a travel and tourism industry transaction processor. So it's based in Madrid, Spain, and it does, search, price, booking, ticketing type stuff. And it's a $37 billion market cap name, Terry, and it's in tech services with a top 18% industry. So here you've got, because it's a tech company, it's a PE ratio on a forward basis of 22.6. So a lower value score, but, if you think the Europeans markets are where to be, here's another name to look into. We got a target price of 95, and right now it's at 82, Terry.
All right, our chief equity strategist and economist, John Blank, on stocks. With John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.